Picture this. You walk past a massive skyscraper in Manhattan. Glass and steel, gleaming in the sunlight. Inside, traders are moving billions of dollars with the click of a mouse. Money is flowing like a river through invisible channels. Fortunes are being made and lost in milliseconds. But here's the thing, this isn't a bank. At least not the kind you're thinking of. Welcome to the shadow banking system. A parallel financial universe that operates in the dark, away from the regulators, away from the rules, away from the public eye. And get this, it controls $65 trillion. That's not a typo. $65 trillion. To put that in perspective, that's nearly double the entire US economy. It's bigger than all the traditional banks combined. And yet, most people have never even heard of it. So what exactly is shadow banking? Why is it so massive? And why can't anyone seem to regulate it? Oh. And by the way, this system was at the heart of the 2008 financial crisis that nearly collapsed the global economy. Yeah, we need to talk about this. I'm going to break down the shadow banking system in a way that actually makes sense. No jargon overload, no boring economics lecture. Just the real story of how the world's money actually moves, who's really in control, and why you should absolutely care about this. Let's dive in. Alright, first things first. What even is shadow banking? Think about a regular bank. You know the deal. You deposit your money. They give you interest. They loan that money out to other people. They make a profit. Simple. But here's the key thing about regular banks. They're heavily regulated. They have to follow strict rules. Keep a certain amount of cash on hand, report to the Federal Reserve, all that stuff. It's boring, but it keeps things relatively stable. Now, shadow banking? Completely different game. Shadow banking is basically all the financial activities that look like banking. Smell like banking, but aren't actually done by banks. It's lending, borrowing, and moving massive amounts of money, but outside the traditional banking system, outside the regulations, outside the safety nets. And here's where it gets wild. Shadow banking isn't some underground operation run by shady characters in dark alleys. No. This is Wall Street. This is hedge funds, private equity firms, money market funds, investment banks, and a whole ecosystem of financial entities that have figured out how to do banking without being banks. Genius? Maybe. Terrifying? Absolutely. The term shadow banking was actually coined by an economist named Paul McCulley back in 2007, right before everything fell apart. And man, did he nail it. Because these institutions operated in the shadows, doing all the risky stuff that banks do, but without any of the oversight. But why would anyone want to operate in the shadows? Well, that's where things get interesting. Let's be honest, regulations are annoying if you're trying to make money fast. They slow things down, they limit your risk-taking, they eat into profits. After the Great Depression, governments around the world put heavy regulations on banks. They wanted to prevent another economic catastrophe. So banks had to play it safe, keep reserves, get insurance from the FDIC, all that protective stuff. But Wall Street had other ideas. Starting in the 1970s and really exploding in the 1990s and 2000s, financial innovators started thinking, what if we could do all the profitable stuff that banks do, lending, leveraging, investing, but without all those pesky rules? And thus, the shadow banking system was born. These institutions found loopholes. They structured themselves differently. They weren't taking deposits from regular people, so technically they weren't banks. That meant they could operate with way less oversight. They could take bigger risks. They could use way more leverage, basically borrowing tons of money to multiply their bets. And for a while, there was a goldmine. Investors loved it because returns were massive. The institutions loved it because profits were soaring. Everyone was making money hand over fist. But there was a problem. Actually, a massive economy-destroying problem. But we'll get to that, so who are these shadow bankers? Let's meet the cast of characters. Hedge funds. These are the cowboys of finance. They pool money from wealthy investors and make aggressive bets on everything from stocks to currencies to derivatives. They use complex strategies and massive leverage to amplify returns, and they're barely regulated at all. Private equity firms. These guys buy entire companies, restructure them, squeeze out profits, and sell them off. They operate behind closed doors, managing trillions in assets. Companies like Blackstone, KKR, Apollo, these names control huge chunks of the economy. And most people don't even know what they do. Money market funds, ***. These seem innocent enough. They were supposed to be safe places to park cash and earn a tiny bit of interest. But in 2008, we learned that even these safe funds could freeze up and cause panic. Investment banks. Before 2008, investment banks like Lehman Brothers and Bear Stearns were doing all kinds of shadow banking activities, packaging mortgages into securities, trading derivatives, using massive leverage. They looked stable until suddenly they weren't. Repo markets. Okay, this one needs its own explanation because it's absolutely crucial. The repo market. This is where things get technical, but stick with me because this is the secret sauce of the whole system. Repo stands for repurchase agreement. Here's how it works in simple terms. Let's say you're a hedge fund and you need cash for the night. You have a bunch of assets, stocks, bonds, whatever, but you need actual cash right now. So you go to another institution and say, "Hey, I'll sell you these assets today, and I promise to buy them back tomorrow at a slightly higher price." Boom. You just got short-term cash. The other institution gets a tiny profit. Everyone's happy. Now, this might sound innocent, but here's the thing. The repo market is massive. We're talking about trillions of dollars being lent and borrowed every single day. It's the grease that keeps the financial machine running. But it's also incredibly fragile. Why? Because it's all built on trust and collateral. If people suddenly don't trust the collateral like, say, mortgage-backed securities in 2008, the whole system can freeze overnight. And when the repo market freezes, credit dries up, companies can't function, and the economy grinds to a halt. In September 2019, we got a scary reminder of this when the repo market suddenly spiked. Overnight lending rates, which are usually around 2%, shot up to 10% in a matter of hours. The Federal Reserve had to step in with hundreds of billions of dollars to calm things down. Most people didn't even notice, but on Wall Street? Panic. Because everyone knows, the repo market is the beating heart of shadow banking. And if it stops, everything stops. Alright, let's talk about the elephant in the room. The 2008 financial crisis. You've probably heard the story. Banks gave out bad mortgages, packaged them into fancy securities, everything collapsed, millions lost their homes, global economy tanked. But what you might not know is that shadow banking was absolutely central to the whole disaster. Here's what happened. Banks were originating mortgages, but they didn't want to keep them on their books. Too risky, tied up too much capital. So they came up with a brilliant plan: package thousands of mortgages together, slice them up into tranches, and sell them as securities. These were called mortgage-backed securities, or MBS, but who was buying these securities? Shadow banks. Hedge funds, investment banks, special purpose vehicles, all these entities outside the traditional banking system were gobbling them up, using borrowed money to amplify their returns. And here's where the repo market comes back in. These shadow banks would use those mortgage-backed securities as collateral to borrow even more money in the repo market. Then they'd buy more securities. More leverage, more risk, bigger profits. Everyone thought they were geniuses. Housing prices were going up, mortgages were performing, the securities were rated AAA by credit agencies. What could go wrong? Everything could go wrong. When housing prices started falling in 2007, those mortgages started defaulting. Suddenly, those AA securities were worth ... not much. The collateral backing all those repo loans, worthless? And then the dominoes started falling. Bear Stearns collapsed in March 2008. Lehman Brothers went bankrupt in September. IG needed a massive government bailout. Money market funds broke the buck, which means they couldn't even give investors their money back. The shadow banking system, which had grown so massive and interconnected, was now melting down. And because these institutions weren't traditional banks, they didn't have access to the Federal Reserve's emergency lending facilities. They didn't have FDIC insurance. They were on their own. Except they weren't really on their own. Because if they failed, they'd take the entire economy down with them. So the government had to step in anyway, bailing out companies that had operated in the shadows, outside the rules, taking massive risks. The American public was furious, and rightfully so. So after 2008, you'd think there'd be a massive crackdown on shadow banking, right? New rules, new oversight, make sure it never happens again? Well, sort of, but not really. Congress passed the Dodd-Frank Act in 2010, which did tighten some regulations on banks and created new oversight for some large financial institutions. But shadow banking? Still mostly in the shadows. Here's why regulators struggle. Asterisk first, it's incredibly complex. Shadow banking isn't one thing. It's a web of interconnected institutions, markets, and instruments. You've got hedge funds in the Cayman Islands, private equity firms in Delaware, repo markets operating 24/7 globally. How do you even begin to regulate that ***? Second, it's international. Money flows across borders instantly. If the US cracks down, activities just move to London, Hong Kong, Singapore. It's like playing whack-a-mole on a global scale. Third, innovation moves faster than regulation. By the time regulators understand one financial innovation and write rules around it, Wall Street has already invented 3 new ones. Fourth, lobbying. Let's be real, the financial industry has massive political power. They spend hundreds of millions of dollars lobbying to keep regulations light. They argue that too much regulation will hurt economic growth, stifle innovation, make America less competitive, and honestly, sometimes they have a point. Shadow banking does provide liquidity to the economy. It does help companies raise capital. It's not all bad. But the risks? Those are very, very real. So we've established that shadow banking is huge, complex, and hard to regulate, but just how big are we talking? As of 2024, the global shadow banking system is estimated at weight for its $65 trillion. In the US alone, it's around $30 trillion. For context, the entire US GDP is about $28 trillion. The traditional banking system? Around $25 trillion in assets. Shadow banking is literally bigger than regular banking now. And it's growing. After a brief pullback following 2008, the shadow banking sector has roared back. Why? Because the demand for credit is huge, interest rates were low for years, and investors are hungry for returns that traditional banks can't offer. Private equity is booming. Firms are buying everything from grocery stores to nursing homes to defense contractors. Hedge funds are using AI and algorithms to make split-second trading decisions. Money market funds still hold trillions in assets that could evaporate overnight. The Financial Stability Board, an international body that monitors financial risks, has been sounding alarm bells for years. They're warning that shadow banking creates systemic risk, that another crisis could be brewing, that we're not prepared. But the system keeps growing, because at the end of the day, there's just too much money to be made. Okay, real talk. Should you actually be worried about this? The honest answer, kind of yeah. Here's the thing: shadow banking isn't going away. It's too deeply embedded in the global financial system. Your pension fund? Probably invested with private equity. Your company's commercial paper? Probably financed through shadow banking, that money market fund you think is safe? Part of the shadow system. We're all connected to it, whether we know it or not. And the risks are real. If there's another shock to the system, a geopolitical crisis, a pandemic, oh wait, we just had one, a major corporate default, the shadow banking system could freeze up just like it did in 2008. Credit could dry up overnight, markets could plunge. The economic damage could be massive. The 2020 COVID pandemic actually gave us a preview. When everything shut down in March 2020, the shadow banking system started showing cracks. The repo market spiked again. Corporate credit markets seized up. The Federal Reserve had to step in with unprecedented emergency lending, trillions of dollars, to keep things from collapsing. It worked, thankfully. But it showed us that the vulnerabilities from 2008? Still there. Maybe even bigger. The counter-argument is that we've learned from 2008. Banks are better capitalized now. Regulators are more aware. Central banks know how to respond quickly. Maybe that's true. But shadow banking is designed to operate outside those safeguards. That's the whole point. So should you panic? No. Should you be aware? Absolutely. Should you hope that policymakers and regulators are paying attention and preparing for the next crisis? Hell yes. All right, let's wrap this up. The shadow banking system is a $65 trillion parallel financial universe operating largely outside of traditional regulation. It includes hedge funds, private equity firms, money market funds, and the repo markets that fund it all. It provides crucial liquidity to the economy, but it also creates massive systemic risk. In 2008, the shadow banking system nearly destroyed the global economy. We bailed it out, passed some new rules, but the fundamental structure remains. And it's bigger now than ever before. Regulators struggle to control it because it's complex, international, constantly evolving, and politically powerful. The next crisis could come from shadow banking, and we might not see it coming until it's too late. But here, just the bottom line. Understanding how money really moves in our economy isn't optional anymore. This stuff affects your job, your savings, your future. The more people who understand shadow banking, the more pressure we can put on policymakers to actually do something about the risks. Knowledge is power, people. So if this video opened your eyes to a financial system you didn't know existed, do me a favor, smash that like button. Subscribe to the channel and drop a comment below. Tell me, did you know about shadow banking before watching this? Are you worried about it? What do you think should be done? And hey, share this video with someone who needs to know about this. Your friend who's into finance, your uncle who's always talking about the economy, your teacher, whoever. This is important stuff and it needs to be talked about. I've got more deep dives into the financial system coming your way, so make sure you're subscribed with notifications on. Trust me, once you start understanding how the money world really works, you can't stop learning. Thanks for watching, and I'll see you in the next one. Stay curious, stay informed, and stay skeptical of anything operating in the shadows. Peace.